Welcome back to the O Show, everything crypto and NFTs every day. I've actually got a very old friend of mine that I've known since 2018, Miko?
Yeah, sounds good.
2019? I don't know. It's been a long time.
I am very old.
No, not you, silly, not you. Okay. If you guys don't know who Miko is, Miko has been in the space for a very, very, very long time, like does a lot of different cool things. But the reason why I'm having him on is because he's a VC. And there's a big bad rap when it comes to VCs. Me personally, I've got some issues with you guys. I'm not gonna lie. But the reason why I wanted Miko to come on is not only is he a very good friend of mine, but he's willing to come on and like be very transparent with us, answer some of my questions, talk to us about how VCs make money, what is an ethical response when it comes to being a VC, like all of those types of things. And Miko, why don't you go ahead and tell the audience who you are and kind of what you do in the space? Elaborate a little bit more.
Yeah, absolutely. So, I guess I've been working in Silicon Valley about 30 years, mostly on open source software startups, and recently about 4 years ago, we launched a crypto fund, a $21 million crypto fund in the venture capital model. And, I think we're about eight unicorns in on that fund, and we're building more. So, in essence, like it is venture capital, and that's kind of how I've been operating in this space. So we did raise a larger fund too, which is about 110 million, and that we're currently deploying that. So that's a bit about myself.
Deploying capital, you say? I'm just kidding. I'm kind of making fun of Justin's son and Doge.
Yeah, exactly.
Well, I have a question.
Steady, lads.
Oh God, help us. Lord, help us. Can you explain to us because you said 8 unicorns, can you explain to us what that means? Because let's face it, most people did not get an education regarding finance in public school.
Yeah. So, it's basically our model is classical venture. There's a lot of people calling themselves venture capitalists, right? And the venture model, the classical venture model is you raise a fund. The fund lasts supposedly for about 10 years, right? And in 10 years, so the average unicorn, if you read the book Super Founders, you'll see that a unicorn is basically $1 billion project company, or it's $1 billion entity in terms of valuation, right? So the total value of the entity, right? So in a sense, like if you think about that, the history of the space, obviously crypto may be a little faster, but the average time to unicorn traditionally has been about 4 years. Trailing up to about 7+ years, right? So typical venture fund will be a 10-year life cycle fund. And the approach that's taken is that you basically go typically to the early stage. There's such a thing as kind of late stage venture capital, et cetera, right? But ultimately, the classical model is you diversify, you write a bunch of checks to a bunch of projects fairly early, and what happens is you're relying on a principle called asymmetry. So asymmetry is if you write a check, the maximum you can lose in that single check is all of it. Right? That's the most you can lose, right?
Right.
Whereas the question you have to ask yourself when you're looking for asymmetry is what's the maximum you can gain, right? So for example, let's say I invested a check $1 million into a brand new sandwich shop, right? So
Okay.
like it's unlikely that the sandwich shop will give you 1,000x return, right? So in a sense, like, asymmetry is the principle that you really look at the sort of what are the best possible outcomes, and then you kind of figure out how to diversify so that you can get some very high growth outcomes in your fund, in your portfolio.
Okay, so basically you guys are writing, so what VCs do is they write checks to different companies, and they write those checks anticipating that they're going to get a large return in the future. And VCing properly is staying with this company that you're investing in, that you've cut the check to for 5 to 10 years.
Yeah. That's very normal. There's interesting dynamics. Like for example, if you're an entrepreneur, one of the things you should look at is you should look at kind of like how fresh the capital is, right? So for example, let's say a venture capitalist invests in you out of a fund that's 9 years old, right? So that fund may be forced to exit its position in a year, right? Because it's in the ninth year of its vintage, right? So that's something that I think people need to be aware of, and so they need to understand,
Ah,
things like that. I think to me, like, definitely read if you want to learn about asymmetry. Definitely read Zero to One by Peter Thiel. Talks about the power law distribution of venture portfolio returns. I think that's a super useful treatise on kind of diversification, and in a way, like, his point is that venture capitalists are people who don't know what to do. And the evidence of that is they diversify, right? So if you actually knew what to do, you would just put everything into a single thing, which is what entrepreneurs do. So that's kind of my mindset.
so, well, because I like to diversify too, but I'm not a VC.
Yeah, diversification is what you do when you don't know what to do, which I think is smart and
Right.
good, valuable.
Yeah, I think it's good. But so I want to actually kind of ask you a hot topic here. We have a lot of people that claim that they're VCs in the crypto space, and we all know that crypto.
Sure do.
We all know that I'm not a VC. I don't want to be a VC. I'm happy being WendyO Capital. We're not there yet. We're getting close. But I just want to know, like crypto moves so fast. So when we're talking about 5 to 10 year investment strategies for traditional companies, you guys take that same energy over to crypto companies. Like, let's say you want to invest in a tech startup, and generally it's a 5 to 10 year investment, but like in crypto, we move a lot faster. You guys still investing 5 to 10 years, or you're pulling out faster? Maybe like
Yeah,
one
yeah,
to two
yeah.
years.
We still have the classical venture time frame and the classical venture model, right? And the way that we do our business is we really look for builders, right? So we really look for people who have ultra high conviction, who have kind of a track record of achievement, or if they don't have any previous achievement. And when we say achievement, we look for achievement in any walk of life, and it's overcoming any challenge, even if they come from a disadvantage, they may actually have overcome multiple challenges, so,
Mhm.
it doesn't have to be, you went to Stanford, it doesn't have to be you exited $1 billion company, so, we just look for any achievement or overcoming any obstacle as kind of a demonstration of kind of grit and like energy, and and then we look for builders, so people who are building things, so really the early stage game, a lot of it becomes about sort of figuring out, it's a people business. If you want to understand kind of the dynamics of the people business, you should definitely read Angel by Jason Calacanis. He's great, really transparent about his business, how he does angel investing. It's useful. It's a very much a Silicon Valley classical mindset, but it's that mindset has been functional for decades through bull and bear markets for technology.
So how do you guys deal with transparency? Because obviously in crypto, like we have public wallet, like we have wallets, like you can track everything on the blockchain. Are you guys cutting cash to these companies that you're investing in? Are you guys utilizing crypto? Like you deploying capital via crypto?
Yeah, I mean, I would say that increasingly and probably more often than not, we're deploying used by the use of like stablecoin instruments. So that's that,
Okay.
so USDC and the things of that nature. So we definitely kind of perform these types of things. But the tradition in venture capital is that the entities are privately held. So like, if we're investing in, things like a DAO, like that tends to be on chain and very transparent, and
Mhm.
if we're investing in things like a startup company, then there isn't any requirement for a privately held startup company to have transparency, right? And in a sense, there kind of never has been, right? So that's sort of the, we don't really dictate the privacy policies of our investment portfolio. We really just allow them to be transparent. With respect to kind of our transparency, like I'm very happy to kind of answer questions. I'm very happy to kind of share methodology, and in fact, I have a YouTube show. This isn't really shilling my show. It's really actually talking about what I do, which is I take private conversations and I just make them public. So, if you want to be like, oh, I want to sit in on their secret evil meetings where they smoke the cigars, like, I don't smoke cigars, but like I make a lot of my meetings just public on YouTube, and it's you can just see what we're saying to each other. So
That's actually really important. I'm glad you do that, because I feel like there's a lot of VCs that get a bad rap. And I'm not going to name the firm right now, but there's a firm that's under a lot of heat that you haven't seen them tweeted for a couple, you haven't seen them tweet for a few days. It looks like their pools, some of the stuff they were invested in, a lot of things are kind of going crazy. So it's like, I feel like I don't know. Like me personally, I would like to see, I want VCs to be more transparent about their unlock dates for the tokens. Cause we know, and I'm not necessarily saying, I'm saying that there's a lot of VCs that are getting these getting these allocations and these different things, and they're dumping them on the market and not being transparent about it, which is kind of, cause that the VC,
Yeah.
y'all get the really good seed rounds.
I mean, I think this, right, which is that when you think about it from a biosphere perspective, right, that if you think about the way that venture capital derives kind of caloric energy, right, there's different breeds of them, right? So, for example, like if you think about, a sort of a long time horizon venture capitalist, right? A long time horizon venture capitalist is really more like a farmer, and not like a DeFi farmer, but actually like someone who's cultivating crops or cultivating livestock. Right now, ultimately, they have to like kill a few cows, and then the other cows get to live or whatever. But my point, that's when they have to sell, right? So
Right.
my point is that the farmer is not farming for the best interests of the plant or the cows, right? And there are others that are predatory, so predatory venture capital, because ultimately, from an ecological perspective, like all the organisms that have an economic basis have to live, and they have to
Right.
live by kind of getting calories. And the question is, where do they get the calories from? Right now, even builder aligned venture capital is getting calories from builders, right? So in a sense, like you could argue that it's parasitic. You could argue that, so the question becomes like, is the relationship between a farmer and livestock, is it parasitic? You could argue it is, right? So in a sense, like, there now the question becomes like, is builder aligned long time preference venture capital better than kind of like a quick flip venture capital that kind of uses, and some mechanisms that are used are kind of like, scaring people on Twitter, and then dumping, or buying, sort of there's sort of pump and dump, right? And then there's kind of like poop and scoop, so there's all these mechanisms that people are using, but in a way, like, that's a very different class of VC, right? That's more like a liquid token hedge fund that's sort of using whatever mechanisms at their disposal. I think if you look at it as nature, right? Like if you just go out into wild nature, there's definitely like, you could argue that like the weaker animals are the prey, right? So, if you're scared about things you read on Twitter and then you sell and you panic sell, like you're definitely one of the weaker creatures. I mean, it's kind of, I don't want to sound evil, but that's just who you are,
Yeah,
and
no,
you shouldn't be that.
I actually totally get it. And that's very interesting that you say that. There's a lot of information to process, honestly. One of the things I will say, I totally agree. Don't listen to people on Twitter. You guys take the bits and pieces of information you see on Twitter and then, figure out what you want to do. That's kind of key, and that's kind of crucial here. Another thing that you made very clear is that VCs and people, like when we're talking about a market, we're talking about entering a market, everybody's in it for themselves. Like everybody's in it to make money, to thrive, to do better, to improve their quality of life. And if you enter into a market, you might be the one that gets caught holding the bag. So it's a game of who's going to get caught holding the bag or not. And is that the proper way that VC, like that's a VC mentality too, correct? Like a trader's mentality, like I'm not going to get caught holding the bag.
Well, I would say the following, right? Which is that, like, when you think about long time preference, like, we're willing to accept fairly long cliff and lockup structures because we
Right.
don't plan to dump. Like we don't plan to have optionality because it doesn't make sense, like in our business model, right? But other so-called VCs have a business model with maybe they have a hybrid model with liquid tokens, or maybe they're just pure liquid token model, and if so, they're going to ask for really exorbitant. They're going to ask for super short vesting. They're going to ask for lots of things. If someone asks you for shorter vesting than the team, then they're obviously planning to leave before the team leaves, right? So so in a way, like I feel like you can suss out who these people are, but I feel like one of the sad things is that VCs do transactions, thousands of transactions, and entrepreneurs tend to do very few, right? And so because of that, there's a lot of predatory behavior that people they fall victim to, right? So to me, like one of the things entrepreneurs don't do that I think is really silly is they don't actually call references on the people they're going into business with. They're just like, oh, like they're giving me money and money's green, so, and I'm the person who's spending the money, so
Yeah,
I trust
no,
myself,
I'm
so
actually
everything's
gonna,
fine.
I'm
It
gonna
doesn't work
interject
like that.
here. I'm gonna interject here. I have a team of people behind me that help me do stuff. Before we put capital into any project, before I even invest in stuff, I ask the team, I say, can you look at this? And we have a very extensive list we look at. We look at the backgrounds, we look at the communities, we look at the tokenomics, we look at the code, we look at the socials, we look at everything. And we decide, is this a good idea? Do we want to put capital in here? Does this make sense? You know, obviously we have a profit taking strategy, but I'm just not going to toss money at you. I'm not going to toss money at you just because this thing is going to pump. I don't care what it pumps to. I want to know that it's going to kind of sustain, because a strategy that I utilize, it's a moonbag strategy. Yes, I get into pre-sales. Yes, I do, you know, get into different allocations and stuff at times, but I have a strategy is once this thing, you know, I always make sure I remove my initial investment, a teeny tiny bit of profit, and then I'll generally hold, I'll stake, I'll do whatever with it. And, you know, I'll take a little bit off the top as time goes on. But we're never dumping anything ever, because I just think that's absolutely ridiculous.
Yeah, that's terrific to hear. And, I think the thing that I think is really, important too is to think about kind of fundamentals, right? Because I think what's happening in this market is that there's a lot of spraying and praying and a lot of stuff that isn't based on fundamentals. It sounds like you've been doing quite a lot of research, and I think that that's really valuable, right? Because, you actually, one of the tweets from this morning was, I said, hey, crypto allows you to send money across long distances to people that you've never met. And but obviously the bear market is telling us like, but why would you do that? It allows you to do something, but it doesn't mean you should do it. Right. So in a sense, like, people are, the olden days are gone where people would just put money in a grocery bag and just hand it across the internet to some rando, in the hopes that everyone would just make money on YOLO crypto, So I'm very much a proponent in the bear of looking at fundamentals, which is, does this solve a problem for anyone, and why are people, the only problem, to me, like there's a lot of cryptos that where the problem is solved is kind of like a casino problem of like, I'm bored. I want to like make money without working. Like those aren't problems that are being solved. Those are just like, that just creates more problems.
I agree with you 100%. Well, that's going to be the show for today, because I want to actually get you on a lot more to talk more about this stuff, especially with all these crazy things we're seeing happening. I'm not gonna name any companies right now. I'm sure y'all know what's in the news. But anyways, Miko, I want you to send, before we go, you guys make sure you follow him. I'm going to have all his links down below. I highly recommend you probably pop into his YouTube channel to educate yourself a little bit, because it's going to be free. And if you're going to get to hear some alpha that he has to offer about being a VC, this is probably going to help you make some more educated investing or trading decisions in the future, and help you kind of hone in on some of the skills or build onto your existing skills. We like to advocate for free information here. And you have a VC who's being very transparent, that's willing to share some information with you. I'm not saying to invest in all his portfolios. I'm not saying to copy trade him. I'm saying to listen to what he has to say. Miko, any final thoughts before we go?
Yeah, absolutely. And it is super important also to understand entry price, right? So, I definitely would disrecommend people to follow things that I'm kind of looking at, because by the time you're seeing them, like, I've either invested or not, but like, my entry price may be different from yours. So, it's definitely not appropriate for people to look at it that way. What they should be looking at it from the perspective of is kind of information, knowledge, right? Learning, and then if you have that information, you can then apply it to, whatever you're looking at.
Of course. Awesome. Well, you guys make sure you go follow him and just listen to what he has to say. Anyways, Miko, thank you so much for coming on. We will chat soon.
Okay. Always a pleasure. Talk soon.